Hey everyone, I recently hosted a webinar for business owners about something that I'm incredibly passionate about, and that's exit planning. And the feedback was amazing, so I thought why not share it here on the channel so even more business owners can benefit from it. So this is an exit planning masterclass where I walk you through the 3 stages of readiness that are all critical to maximizing the net proceeds from selling your business and transitioning into retirement with the most money and peace of mind. So if you've ever wondered how to step away from your business on your terms with clarity and confidence and with a solid financial plan for the next chapter of your life, this video is for you. At Beyond Your Exit Wealth Management, we specialize in helping business owners like you prepare for and navigate this process. So grab a notebook because there's a ton of actionable advice packed into this video. And so here we go. All right, welcome everyone, and thank you for joining me today. My promise to you during this webinar is simple. I'm going to give you actionable steps to maximize the value of your business, show you how to avoid common pitfalls that can cost you time and money, and most importantly, how to transition into a life of purpose and financial freedom post-sale. And I want to be clear about the strategies I'll share today. These aren't just theories or generic advice. Whether you're running a service-based business, whether that's HVAC, plumbing, or electrical, the principles of exit planning are universal and will work for any business. And I know this because I use them with my business owner clients, and they're proven methodologies grounded in research conducted by the Exit Planning Institute and another organization called Tiger 21, which is an entrepreneur peer advisory group. Now, many of you might be wondering, why should I listen to you? Well, I bring over 15 years of experience in financial planning to the table. I have various designations all listed below, but more importantly than those is this is literally all I do. Hence the name of my firm, Beyond Your Exit Wealth Management. And that's having a mission to help business owners like you plan your transition out of the business, manage your wealth, and most importantly, help you step away on your terms with clarity and confidence about your future. What I'll share today isn't just about selling a business, it's about creating a plan that aligns with your goals and what's most important to you. So with all that said, let's begin. Here's what we'll cover today: why planning your exit is critical, the common challenges of not having a plan, the 3 components of exit readiness, the key steps to creating a successful exit strategy, and how to position yourself for financial freedom after your exit. So each of these topics builds on the other. So stick with me. I have a lot to cover today, but I can promise you by the end, you'll have a much better understanding of what it takes to exit on your terms. So first, I want to address a wild statistic provided by the Exit Planning Institute. Did you know that only 20% of businesses listed for sale actually sell? That means 80% of owners don't achieve their goal of exiting or slowly transitioning out. And on top of that, over 75% of them regret their decision within a year of selling. The most common reasons for this are because they didn't get the best deal, they were not ready to fully leave the business, or they didn't plan well enough for life after and how they would spend their time. So there's not only a monetary cost with the risk of leaving money on the table, but there's an emotional cost if we're not personally and mentally ready to step away. So whether you're thinking of exiting in 2 years or 10 years, proactive planning will be essential, and we'll dive into this in greater detail shortly. Let's talk about the consequences of poor planning. So did you know that 50% of business exits are involuntary? That means 50% of owners are forced to exit, usually because of dramatic, unanticipated life events. And we call these the 5 Ds: death, disability, divorce, disagreement, and distress. Now, these unexpected events force many owners to exit under less than ideal conditions. Think about it. If you didn't show up to the office tomorrow, or for a week, or for an entire month, who would take over your specific role? By planning ahead, you can protect everything you've built, and not only your business, but your family and your legacy from these 5 major risks. So what can we do? How should we be thinking about the transition process? Well, think of a stool with 3 legs. We have personal readiness, we have business readiness, and we have financial readiness. Each leg will be critical for a successful exit strategy. If one leg is missing, what do you think is going to happen? The stool falls over, right? The same applies to your exit strategy. Let's break these down even further, starting with personal readiness, which is about knowing what's next for you and how you're going to spend your time. Then we have business readiness, which is all about maximizing the value of your company. And finally, we have financial readiness, which is about making sure you have the resources to support your desired lifestyle after the sale. Alignment of all three will be key for a successful transition. So let's break each of these down even further into actionable items you can start working on as early as today. Starting with personal readiness. Personal readiness starts with understanding your personal goals and defining what's next for you. I mean, think about this. If you sell your business at 60, you might live another 20 or 30 years. How will you spend that time? And no, you can't just say you're going to play golf. I've spoken with and interviewed many others who have gone down this path already, and golf will only get you so far. Now, I realize this is also not easy, and it's a very common challenge for us to struggle with separating our personal goals from our business goals because business is personal. They intertwine together and play a significant role in not only what we do, but who we are. So on the next slide, I want to share several exercises that we guide owners through, and you're welcome to copy the template, take a screenshot, and do this on your own. The first is to break down your ideal week hour by hour for each day as if you've had all the resources you need to live exactly as you'd like. So there's no money limitations and there's no time limitations. What does that look like? Then compare that to your current schedule and how you're currently spending your time throughout a typical week. And after that, ask yourself, am I prioritizing what truly matters? Next, we're going to do the same thing but zoom out and describe month to month how would you spend your ideal year. Again, keeping in mind as if you've had all the resources you need to live exactly as you like. No money limitations and no time limitations. Finally, write down how you currently spend your time month to month throughout a typical year. Again, ask yourself, are you prioritizing what truly matters? And through a series of additional questions we have and having a conversation, we often discover our time, money, and attention are not aligned with what's most important to us. And so these exercises will help you identify and prioritize your personal goals first, then align those goals with your personal financial targets, finally moving down to your business goals, which drive everything to make it all happen. But now your business will start working for you as opposed to you working for your business. I can't stress how important this is because what happens is many owners face an identity crisis after selling because they've tied their self-worth to their role in the company. Some go through the entire exit planning process only to get to the table with a buyer and potentially sell, to then only walk away from the deal because they weren't ready. Now, I also recognize this is difficult to do, and many of you listening to this will put this exercise on the back burner. I actually assign this as an exercise and go through it with business owners, and many come back with the sheets completely blank. I also have others, they come back and it's completely filled out too because they're excited for the next chapter of their life. So everybody's different, but going back to the three legs of the stool, you can have a very valuable business. You can also be financially ready, but if you're personally not ready and your identity is still tied to the business, that's where people get cold feet. That's where they walk away from a deal at the last minute and they have regret. So we can't skip the personal readiness step. Next is business readiness, which is all about maximizing the transferable value of your company. The key word here is transferable, which is how valuable is your business to someone else if you are no longer involved. Now, many businesses rely too heavily on the owner, which can be a huge red flag to buyers because if something happened to you, the business would either go under or severely struggle to stay afloat. So to make your business more attractive, The goal is to make your business less dependent on you by improving on key value drivers. Now, here are 8 of the value drivers, and I'm not going to go into each one in great depth, but I will explain them and dive deeper into 2 of them in the coming slides. First is financial performance. Now, these are easy to understand, but very difficult to deliver. So that's your top line revenue and bottom line profit. And not only what those numbers are, but the quality of the reporting of those numbers. And we'll dig more into this one shortly. Next is the Switzerland structure, which comes from the idea of Switzerland and how they have this passion for being very independent. But independence is essential to having a saleable company. This means avoiding concentration issues. So that's not depending on 1 or 2 of your biggest customers to bring in the bulk of your revenue. That's not being overly reliant on any one key employee and not overly dependent on any one supplier, but being diversified across all 3 of these will not only lower your risk, but also increase your attractiveness to a potential buyer. Next is recurring revenue. So for trades businesses, this would be maintenance agreements as an example. But overall, recurring revenue helps with forecasting and predicting the likelihood of future cash flow. To buyers, if you have sustainable recurring revenue, that can add a ton of value. Then we have customer satisfaction, which focuses on what's called the Net Promoter Score. And this helps quantify and measure client satisfaction. So if you've ever gone to the website of a business, this is the pop-up that comes up with a score from 1 to 10 on how likely you are to recommend the service or product to another person. This is the Net Promoter Score. Buyers want to know how satisfied the clients and customers are. And so the higher the Net Promoter Score over a long period of time, that can benchmark the performance and show the likelihood that customers will recommend the services or products of the business and repurchase. Then we have growth potential. Now, the biggest misconception that I run into with this one is owners are really proud of what they did in the past. Business accomplishments they've achieved, or that they've been in business alone for 30 years. And the hard truth of it is, buyers are not buying the past. They are buying the future stream of profits in the business. They're thinking, what is the future potential of this company? Can it operate in a different market? Can we cross-sell products to existing customers? Or are there ways to scale into markets A, B, and C? So buyers are forward-looking and don't really care about what happened in the past. Then we have valuation teeter-totter. So if we can take a step back and imagine a seesaw at a playground, and you have one little kid on one end and a bigger kid on the other, the big kid gets on and shoots up and reverses. It's the same relationship that exists between the way cash moves through the business and its value. Essentially, when a buyer comes and buys a business, they're going to write 2 checks. One goes to the owner, and the second one is going to fund the company's working capital. So the more cash the company sucks up and needs to operate, the less they are going to be willing to buy the business. So we need to make sure the business is generating cash. For example, if you're collecting receivables, is there a way to collect them faster or collect more money up front? This would make your business more attractive. Then we have monopoly control, which is how do you differentiate yourself? This gets into the marketing strategy and how a business communicates their messaging. And essentially, you'll need to ask yourself 2 questions. Does this make us different? And do our customers care? If you're able to have 2 really good answers to those questions, that will help your business be more attractive. Finally, there's hub and spoke. And this is how dependent is the company on the owner personally. The idea is the owner is the hub, and the spokes represent everything coming back to them. So this is when employees come to you when they have a question. This is when customers come to you when they need a quote. Or this is also when suppliers come to you when they want to buy something. The hub and spoke will be the priority for many business owners, and we'll dive into this one in great depth in the coming slides. This slide is a quick visual comparing 2 companies with the same financials. But when you look underneath the hood, these companies are actually very different. And my question to you is, Which one do you think has transferable value? Company A with no CRM system, worn equipment, and little employee training? Or Company B who has a strategic plan, CRM, they have up to date quality financials, and documented processes? I'm sure we can all agree Company B has the transferable value, right? But the point is, if you have a profitable business, that doesn't mean you have a saleable business. And listen, if this is you, that's okay. If you're happy in your role, you're making money, you love what you do, and you have happy employees that love to come to work, that's all really great. Just understand that if one day when you want to or need to sell, it will be very difficult to make that happen without doing any planning. For most of you on this call, owner dependency will be your highest priority. Think about it from a buyer's perspective. If you are the one making the sales, if you are the face of the business, if you're the one in the truck going to all the appointments, would you want to buy that business? Highly unlikely. Because if that owner leaves, everything is going to go right along with him. So there needs to be a mindset shift. Going from being very hands-on and involved as the owner operator to taking a step back and putting your time, money, and attention into big picture strategic planning for the business. Now, this doesn't happen overnight either, right? It can take a lot of time. Where you start depends on the state of the business. So I highlight some of the key processes to have in place to help lay the foundation. Creating processes and SOPs that are centered around building and managing your team will allow you to delegate more and surround yourself with a quality and reliable team, giving valuable time back to you. This is building human capital. Because you've defined and documented how to do it, because you've documented how to hire and what metrics to hold your team accountable to, you've documented how to recognize your rockstar players and what growth opportunities they may have. This all spills over into retention and keeping good employees. And listen, I get it. Retention is hard. There's businesses I'm working with that have a lot of older employees in important roles, and they need to find ways to start backfilling those positions just in case those folks decide to get up and retire. But let's take hiring, for example, and we'll break this process down so you can understand how detailed these processes need to be. Have you identified the type of person you are looking for? How do you let the public know you're actually looking? What's your vetting process, onboarding, training? Is it all systematized and automated? The more detailed the process, the easier it will be to delegate. Now, one of the biggest barriers to a successful sale is messy financials. Buyers want clean, reliable financial records that are defendable. That means working with a professional bookkeeper or a certified public accountant and adhering to GAAP standards. If your financials are unclear or incomplete, it can literally kill a deal. So start by getting your financials scrutinized right now before buyers get involved to address any red flags. Because here's what happens. When you enter a deal and sign what's called a letter of intent or an LOI, what's next is called due diligence. This is where the buyer comes in to look at everything under the sun regarding your business. And that includes digging into your financials. So having clean and accurate financials will be critical to getting the most from your company. Finally, let's talk about financial readiness. This means planning for your desired lifestyle without relying on the income from the business. Just like you have a balance sheet for your business where you can click, pull up the report, you have a current snapshot of everything that's going on, we also need to know what's going on in our personal finances and have a personal balance sheet giving us a holistic perspective of where we're at, right? Many of us know more about what's happening in the business than our own personal bank accounts. So on the next slide, I have an example of what this looks like. So taking the time to organize your current assets, that's your taxable brokerage accounts, your pre-tax, tax-free accounts, real estate, and business interests are all listed on the left, and all of our personal liabilities are listed on the right. The difference between the two gives you your total net worth. Now, when you do this, It's very common that close to 80% or more of your net worth will be tied to your business. We can see that here in the dark blue. Now, although that's quite an accomplishment, like this company here, it has a $3 million value, it presents a major risk because the likelihood that business has transferable value worth $3 million to a buyer is statistically quite low, meaning $3 million is locked up in a potential illiquid asset. And so here's what happens. Once we're clear on where we're at today in our current state with our personal finances and the value of our business, we need to define our future state if we look on the right side here. So where do we want to be financially 5 to 10 years from now? Where do we want to live? Do we want to be closer to the kids, travel, start a new business? There's all these questions that need to be answered. And honestly, they all usually tie back directly to the exercise we did earlier in the personal readiness step, filling out how do we want to spend our time. So we then quantify how much do we need in a bank account to make this all happen for the future state, and we compare that to how much we have in current assets. And what typically happens is there's usually going to be a gap between where we are right now as the business owner and where we want to go. And the gap can be because of multiple reasons. The most common being we're not saving and investing enough outside of the business. We're not building wealth separate from the performance of the company, i.e. 401k, IRAs, brokerage accounts, real estate. And the other reason is not knowing the true value of our business, so we're either guessing or there's no transferable value. And so there's really only two things you can do to close the gap. The first is to save and invest more outside of the business. And the second is get a business valuation and start increasing the value of the company. And usually it's going to require a combination of both. So that's going back to our value drivers, right? That we discussed earlier in the presentation to increase the attractiveness of our company. It's also making sure you are contributing to a retirement plan for your business via a 401k or SEP IRA. It could also be making it a priority to eventually set up a retirement plan if you haven't done so yet for your company. Or if you're a big spender, maybe it's time to evaluate your expenses and start prioritizing putting enough money away on a monthly basis. So ask yourself these questions. Do I know how much I need to live my desired lifestyle after a transition? Am I on track after factoring in taxes, inflation, and expenses? Am I depending on my business to fund my retirement or the next chapter of my life? If so, how much is my business truly worth, and does it have transferable value? Now, another thing to consider that's really important for financial readiness is trying to figure out your net proceeds, because this will be the bulk of your nest egg that will fund your lifestyle in addition to your current investments. And at the end of the day, we need to know how much is going to end up in your pocket. Now, many think we just have long-term capital gains taxes, which will be 20%, and 20% of 3 million gets us 600,000, bringing us to 2.4 here on the left. But there's a lot more to it than that. Not only do we have capital gains taxes, but we also have state taxes, depending on where you live. And even after that, I just listed out actual examples from a deal that took place earlier this month where money was held back for 90 days contingent on sales performance, or money was held back in an escrow account for 24 months to protect against any lawsuits that could potentially come out of the woodworks after the sale. All of these need to be considered when calculating how much will end up in your pocket. So many of you are probably thinking, how are we actually supposed to manage all three legs of the stool and do all of this while we're running our business? Oh, and by the way, try to have a personal life. That's where, on the next slide, it's so important to be proactive and start building your professional team. Exit planning is not a solo journey. Business owners who have successfully gone through the entire exit planning process had a team of experts, which includes a business attorney, CPA, certified financial planner, and potentially a business broker or M&A advisor. The sooner you start planning for the transition from your business, the more options you will give yourself. You will give yourself more time to get the right people in place, with the right experience to get you the outcome you most want. So to summarize, here are the key steps to strategic exit planning. We need to define your goals, right? Personal, business, and financial goals. We need to understand your business value. So we have to get an accurate business valuation. Then we need to prepare the business for sale, which is working on improving those 8 value drivers. We also need to choose the right exit strategy. And we have here listed sale, merger, or transfer. Now, I know we didn't dig into this into great detail here. I actually dive a lot more in depth on this topic in the free exit planning playbook that everyone on this webinar will receive if you decide to join my weekly newsletter. I'll actually leave a link in the description to check that out. But if you decide to join my Business Exit Success newsletter, you'll receive a free copy of this 50-page exit planning playbook. And I go just a lot more in depth on the transfer options in there. And finally, the last key step is to plan for wealth management post-sale, which is minimizing taxes and creating an income stream from the proceeds of the sale while protecting your legacy. Again, all of this is broken down in more depth in the free exit planning playbook. Before we wrap up, let's quickly review some common mistakes to avoid. The first being waiting too long to plan. Just because we don't have any intention to exit within the next 5 years, that doesn't mean we should put this off. What owners often find is when you start exit planning, you actually fix the business so much and become more organized that it's easier to run, and many at that point actually choose not to sell because they aren't tired anymore, they don't have burnout anymore, and they actually start to enjoy the process again. The next mistake to avoid is ignoring personal financial planning. Now, in my experience, business owners often put the needs of the business before themselves, and I get why they do it. But by doing this, you end up putting your own personal and financial future at risk. So don't forget to get your personal finances in order and get a plan together for yourself and your family. And finally, the last mistake to avoid is failing to engage expert advisors. You don't want to go on this journey alone. Selling your business will most likely be the largest transaction of your life. Most of us will only get one chance to get this right. So start the planning process early, give yourself more options, and put yourself in the best position possible to cash in on your company. If you think we'd be a fit to help, don't hesitate to reach out. Beyond Your Exit Wealth Management offers financial planning. We offer wealth management to business owners who are looking to exit within the next 5 years. Below, there are several free resources, including my podcast, Business Exit Success, and that's available on all the apps for Apple and Spotify. There's also my free exit planning playbook, which again, you can download in the description. And we also offer a preliminary value add to anyone considering partnering with us. We call this the free readiness assessment. And this is a process we go through to help you make an informed decision about partnering with us, where by going through a detailed assessment, we can uncover any gaps in your plan, give you suggestions on how to fix them, and if we turn out to be a fit, we can help you implement them on an ongoing basis. So thank you all again for your time and attention, and I wish you all the best.